Hi everyone. In this video I'm going to discuss about how to calculate weighted average cost of capital or WACC. What do you mean by WACC? WACC means it's an overall rate of return required by a company. What does it mean? What does it mean? Let's say now if a company has debt financing and equity financing, if the capital structure consists of debt as well as equity, then you need to identify the weighted average cost of capital. Now, in order to calculate WACC, you should identify the cost of debt as well as cost of equity. So if you can identify the cost of debt and cost of equity, and if you apply on the capital structure of the company, you can easily calculate weighted average cost of capital. So what do you mean by cost of debt? How do you identify cost of debt? So cost of debt simply means your borrowings. Okay, so if you borrow funds, you will know your interest rate, interest cost. So that will be your cost of debt. So cost of debt will be your borrowing cost, interest cost. Whereas cost of equity, what do you mean by cost of equity and how do you identify cost of equity? So what do you mean by cost of equity? So cost of equity means the rate of return required by an investor or the equity shareholder. So that is cost of equity. So how do you determine the cost of equity or the required rate of return of an investor or the equity shareholder? How you can identify that? To calculate that, there are a number of ways. You can use capital assets pricing model to calculate the required rate of return, which means CAPM. We call it CAPM. Or else you can use build-up method, or else you can use ROE, return on equity method, and or else we can use dividend yield method. Now in this video I am going to focus on the first method, capital assets pricing model. So what do you mean by CAPM and how do you calculate the required rate of return based on CAPM? Now let's move on to the calculation of capital assets pricing model. So in order to explain the capital assets pricing model, let me take a practical example. So let's say there is a project. That project offers an interest rate of 8% or the return rate of 8%. As an investor, so what you can do? As an investor, what you can do? Either you can accept this offer or else you can explore the possibility of other opportunities available in the market. There are two options available. The project is offering you 8%. As an investor, either you can accept the offer or else you can explore other opportunities available in the market. So as an investor, let's say it depends on the risk appetite of the investor, how he is going to invest in the market. So risk appetite, there are two types of risk appetites. So investor can be a risk averse person or a risk taker. So risk averse person means these kind of investors will not take any risks at all. But risk takers, these kind of investors would like to take risk. So therefore, the investor is a kind of a risk averse person. So where he would go and invest his money. So he would invest in risk-free investments where there is no risk at all to invest the money. Such kind of investment would be the government treasury bond. So if you invest your money in government treasury bond, it will be risk-free investments. So we can call it RF. So for this example, this explanation purpose, I have assumed an interest rate of 3% as risk-free investment. So if you want to identify this particular risk-free investment, you can refer to the local government treasury bond rate or US treasury bond rates in order to calculate the required rate of return of an equity shareholder under capital assets pricing model. Now let's say the investor is a risk taker. So where he would go and invest? He would go and invest in the readily available market. For this example purpose, I would take the stock market would be an ideal example for readily available market. Now how you can identify the market return? How you can identify the market return? So you can identify by reference to stock market index. So if you calculate the compound annual growth rate of the stock market index, so you can easily calculate the market rate under stock market investment. So based on my analysis, I got 8.95% as the stock market return. Now let's see, based on this information, how we can identify the required rate of return by an equity shareholder. So what we need to do is, now we have two elements here: risk-free investment, which is represented by RF 3%, and stock market return, which is represented by RM 8.95%. Now to calculate, we can use this formula, which is capital assets pricing model, CAPM. This formula has two components, basically risk-free rate, which is represented by RF, and the market return, which is represented by RM, and risk-free rate of return, which is represented by RF again, and the beta factor. Beta means the risk factor. The risk factor is associated with a particular industry. So it varies depending on the industry. Okay, now let's substitute these figures in this formula. So risk-free rate is how much? 3%. The market rate is 8.95, let's say 9%, and risk-free rate of return is again 3%. Now RM minus RF, what does it mean? The difference is 6%. So this is known as market premium. Market premium means an investor can earn over and above the risk-free rate of return, which is 6%. In order to earn this 6% over and above this 3%, he has to take some risk. So therefore we need to factor this 6% with the industry risk factor, which is given by beta factor. Now for this calculation purpose, I assumed a beta factor of 0.95. It varies depending on the particular industry that you are going to invest. For this calculation purpose, the rate is 0.95. So you need to apply this 0.95 on this market premium, which is the return an investor can get over and above this risk-free rate of return. So that will be, if you simplify this formula, that will be 8.7. So this will be the rate of return required by an equity shareholder. Now let's move on to the WACC calculation. So as I told you in my previous slide, the capital structure consists of debt financing and the equity financing. So you need to identify the cost of debt, and let's say the cost of debt is 3.9%. Now for this example, I have considered a US dollar bank loan. So when you go for a US dollar bank loan, the interest component consists of two elements. One is the interest margin and the other one is the LIBOR. So the interest margin is 1.9. So here I have considered the LIBOR rate for 10 years. It is fixed, which is IRS, means I have taken 10-year interest rate swap rate 2% in order to identify the cost of debt. So this is the margin, fixed component. This is also fixed component. Usually this is a variable rate. The LIBOR rate is variable, but as in this example I have taken the fixed LIBOR for 10 years, so which is 3.9%. Now equity financing we calculated based on CAPM, which is 8.7%. So by applying these two rates to our capital structure, so we can calculate weighted average cost of capital. Now let's move on to the calculation part. Now let's say your capital structure consists of equity capital of 1000, debt financing of 500. So what is your total capital structure? Which is 1500. Now for the equity capital, we have the rate of return required by an equity shareholder will be 8.7%, which we calculated based on CAPM. And also for debt financing for this 500, we identified our interest rate as 3.9%. So to calculate WACC, we have to ascertain the weightage on each component. Out of 1500, equity capital represents 1000. So therefore, what is the weightage on this out of 1500, which is 67%. Which is 67%. So when you take the debt financing of 500, which is out of 1500, the weightage will be 33%. So to calculate WACC, so what you need to do is simply you take the weightage times the rate. The weightage is 67%, the rate is 8.7. So that will be 5.83 as far as equity capital is concerned. As far as debt financing is concerned, you need to simply take the weightage of 33% times 3.9%, which will be 1.29. So when you add up these two, 5.83 and 1.29, so this will be the overall rate of return required by a company, which is known as weighted average cost of capital. So there is another alternative way where you can calculate 7.12, which is simply you apply the interest rate on the capital amount. So 8.7 times 1000 will be 87. So this is the dividend has to be paid to the equity shareholders. This is a dividend payment 87. And the debt financing you need to pay 3.9% on 500. So which will be 19.5. The total commitment, total dividend plus interest will be 106.5. If you take this as a percentage of 1500, which is 106.5 divided by 1500 times 100, you will get 7.12. So this is how you calculate weighted average cost of capital. So this is a basic introduction about weighted average cost of capital. So if you wish to watch more videos on accounting and financing, so you can subscribe to my channel. So thanks for watching. Bye for now.